Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, co-portfolio manager at Hicks & Zuercher Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zuercher Capital Management. Austin, how can people help us with our podcast?
We would love it if you'd subscribe if you're not subscribed already. That way you get new episodes each and every Thursday when they drop. And if you could leave us a review on Apple Podcasts, Spotify, or wherever you listen, that would be great. So today,
yes,
we're going to be talking about why you may want to and how to construct a bond ladder. Bonds are in.
Bonds are exciting.
They've never been this exciting in our lives.
All right. Bond ladder. So that's obviously an upward moving thing, I'm assuming, right? You're climbing out of
something.
Climbing out of the low savings account yields to a higher yielding portfolio. First of all, always a caveat, everything we talk about, not a recommendation, but we will be talking about a asset class within the investing world, and you're going to have to decide whether it fits in your strategy. You're going to talk to your financial advisor, but we're just going to talk about what is a bond and why you'd want a ladder of them physically or in an investment. So we do have an episode on bonds.
Yeah, we should link that in the show notes. But at a high level.
Give me a bond
is a loan.
Okay.
Right? So Josh Robb, suppose he has a corporation.
Yep.
And so this would be a corporate bond we're talking about here. And he needs to raise some capital for a project.
Yep. Improvement.
Expansion. It could be just growth, whatever that may be. So Josh issues a bond. He issues a bond, which is essentially a loan to the open market, is where this would go. Then I would go buy, and I would get interest payments in exchange for loaning my money to Josh for this.
Yep.
Now, the less likely Josh is to pay me, the lower his creditworthiness, the higher my interest rate would be.
Yep.
And the more likely, the lower my interest rate would be. There's less risk.
Yep. So if I said, hey, I got this opportunity to add on to my building and I need $1 million to do that. I need it today because I'm going to start the building. And that's going to give me more money because I have a bigger building to do whatever business I do. And so I would go out and sell 10 bonds, whatever it is, and people would buy them and I would get my $1 million.
Yep.
So I have what I need today. And as a result, let's say it's a 10-year bond. I would say, okay, throughout these next 10 years, since you let me borrow your money, thank you, I'm going to give you some payments along the way as a thank you for letting me have your money up front. I get to do my stuff, expand my business, grow, and I'm paying you interest. I'm paying you those payments maybe twice a year or whatever. And then once that 10 years is up,
boom,
I give you back your money. So if you bought my $1 million bond, I paid you interest along the way, then you get your $1 million back. And that's what a bond does and how it works.
Now on paper, you buy bonds at par, which is exactly their face value, and you get it back at the end. In the real world, it's not always that simple.
Right.
Because we're buying and selling fixed income securities, bonds, in the open market based on supply and demand. So you may, based on what your interest rate of Josh Robb's bonds is, you will either pay a premium or a discount to the market to get your bond.
Yeah. So if I offer 4% interest, but there's a business next door to mine who also is raising money and they're offering 5% interest.
Yours is going to
That's more appealing to somebody lending money. They get more interest. So I'll have to adjust my price to make mine as appealing.
You're going to trade at a premium.
I'm going to be trading at a discount. Because I'm offering less interest.
You're correct.
So I need to get some way of motivating you. So instead of you lending me $1 million, you may only have to lend me $900,000 to get the same thing.
Absolutely.
So, yes.
So
all that to say,
that's a bond.
Bonds are lending money; they get paid back.
Yeah. So like with a stock, you are owning things.
Yes.
An asset. With a bond, you're loaning things. It's kind of a good way to remember it. So let's talk about why you may want a ladder of bonds. Now, a ladder is really just a way to say you want to have this portion of your assets in the fixed income market, and we're going to get into different kinds of fixed income securities, and you want to take away some of the interest rate risk by buying bonds at various maturities over a longer set period of time than just a year or whatever. What this could be is staggering your bond purchases. And say you have $1 million and you want a hypothetical 10-year bond ladder.
Yep.
You could divide that by 10 and buy a bond that matures every single year for 10 years, right? So as each bond matures, so you're going to buy one that's essentially going to mature this year. As that bond matures, you'll get your $100,000 back. Then, if you're doing it as vanilla as you can, take that $100,000 and go buy one the next year. So you always have a 10-year bond ladder. So that's an example of what a bond ladder is. Now, why would you want to do this? It's because interest rates make bond prices move actually a fair bit in short terms. Over long terms, they don't. And at the end, you're always going to get your money back at maturity, provided the company doesn't go bankrupt. So that is why, as interest rates move up and down, your bond value moves up and down. But you don't want any of that to be kind of impacting your overall picture because you have too much eggs in one basket, right?
Yes, correct.
And this essentially means that you'll have a consistent stream of income. Those two components are why a lot of people like bond ladders, because they get a steady stream of income that they can count on, and they take away a lot of the interest rate sensitivity of bonds themselves.
And an important note, this only works with bonds that are maturing in the future. Because bonds that have already matured, that would be called a former, not a ladder.
That would be called a former, not a ladder. Good joke.
There you go.
That was not even his dad joke.
Not even the dad joke. Just thought of it.
So let's talk about how you may go about building a bond ladder.
Side note, this same concept works for other interest-paying, maturing things, CDs those type of things.
Exactly.
You can see those used a lot.
So I think it really starts with talking with your financial advisor. And this is going to be a caveat we're going to say more than once. But when you sit down with your financial advisor, you determine your goals that you want for all of your money in general, and determine that a sleeve of that can be achieved with a bond ladder. So know your investment objectives, your return objectives, your risk tolerance, your income stream desired. That is how you're going to determine that with your financial advisor. So look at the big picture, see if fixed income in general or specifically a bond ladder fits into how you want to invest to meet your goals, and go from there. So that's step one. But really, you can use this to generate income that you can use for living. You can use this to save for certain events or expenses that are far away. These things are reasons you could use a bond ladder. So number two is very key as well. Choose your bond type.
There's types of bonds.
There are types of bonds. So there are government bonds, which, big news. Fitch just downgraded the U.S. They're one step below perfect investment grade.
I saw a thing that was talking about
from AAA to AA+.
That said, at this point, Microsoft has a higher bond rating than the U.S. government. And so the question is, you'll enjoy this, in order for Microsoft, who also has stock or equity, to use their discount models, they have to use a risk-free rate, which by default, people use the government's short-term bonds. Should they switch to their own bond for a risk-free rate because they're actually more stable in theory than the U.S. government?
Here's what I will say. The reasons why the U.S. got downgraded, and we should really probably have an episode on this,
if people want to go to sleep,
is largely around a longer-term trend of fiscal irresponsibility.
And the
matching your inflows and your outflows, and then discussion over not being able to pay your debt. So those two components together have created what we have today. This isn't the first time this has happened. This happened again in 2011 when S&P did the same thing. So yes, the government's going to pay its debt, but this is more of a warning than anything. This does not mean that the government is not going to pay its bills. But all that being said, government bonds, specifically federal government bonds, are considered risk-free, and they are generally the most liquid and stable bonds that you can buy.
There's a big market for it.
There's a big market, not just in the U.S. It is the biggest around the world because everyone wants U.S. dollar-denominated bonds. But there are also bonds of localities. Those are called municipal bonds, and there are different regions that do this. There are states that do this. There are local governments and schools. And they can do it from tax revenue. They can do it for general obligation. All kinds of different ways that they get the income for that. Schools, income tax, school tax, all property these things. These are ways that these municipalities will fund themselves, but also fund the debt that they're incurring to grow, to develop, to do what they want to do. So that's municipal bonds. Now, Josh, what is the key thing about municipal bonds?
Well, and some government bonds, because there's some like E-bonds and EE bonds, all the I-bonds. Some offer tax savings. Some are tax exempt. So municipal bonds are tax exempt.
Not all.
Not all.
But close.
And depending on where they're at and which types you get. And the same is true with government bonds. There are some that, depending on what they're used for and how they're done, are tax exempt. So that is the appeal to some people, is you save some income tax on those. Because again, most bonds, not all, because there are zero interest bearing bonds, but those that pay it interest, you will owe income tax on.
Yep.
But some government and municipal bonds, you do not owe that tax, whether it's state or federal, depending on what type of bond you have.
Before we continue, you brought up a word I want to explain.
Yes.
A zero coupon bond is what it's called.
Yep.
Really? So that is an interesting thing that might throw a wrench in your bond ladder. If you're using it for a stream of income, a zero coupon bond, so the coupon is that interest payment that Josh Robb gives Austin Wilson for loaning him money, right? A zero coupon bond really just means that I go buy Josh's bond at a discount that would incorporate the interest payment already.
And I get it at the end.
And then give me my money back at the end, which brings the gap up from the discount I bought it to par, right? So that's not really as applicable in a bond ladder scenario. You typically would not want.
You don't ladder zero coupon
Yeah, you would
bonds.
not want to ladder a zero coupon bond. So a couple other types of bonds. You talked about municipal corporate bonds. Microsoft was the example you brought up. Most corporations have the ability to issue debt to fund their capital requirements. Big corporations like Microsoft and Apple are some of the best and most stable and lowest yielding because they're the least risky ones out there. But almost all corporations are able to do that, and it helps them to meet their corporate needs there. And then the other fixed income securities are things like mortgage-backed securities. You can ladder out certificates of deposit, all kinds of things like that. I would say that from a financial planning perspective, which kind of account type could have an impact on which kind of bonds you're looking into.
Yes.
In a taxable type account, you may be more considering of municipal bonds and things like that because, well, in most instances, you're going to be able to at least get federal tax exemptions from that. But if you're looking at other types of accounts, potentially tax deferred,
it does matter.
It doesn't matter.
Yeah.
You could get corporates and be fine to go there. So high yield bonds, crazy stuff. So those are bond types. So choosing that is very key. Some people mix their bond types in their bond ladder, and that's not a huge deal, but a lot of times it makes most sense based on your strategy to keep them the same. Third point is select your ladder length, right? So how many years out, what total duration should your bond ladder be? And then you could divide your dollars by how many years your bond ladder is, and then get how many dollars per year in bonds maturing you should have. A lot of people do a 5-year or a 10-year, a 6-year or an 8-year. There's not necessarily a right or wrong. It depends on your needs for your liquidity at any given point in time.
Even known some, because you mentioned this is like maybe it's for a specific need. I knew some that time the maturities around payments due for college expenses. So they bought these bonds that were maturing in the months prior to when tuition was due. So you build that out based on that. So it was a 4-year bond essentially with payments twice a year for tuition.
And the fourth step, diversify the maturities. So again, you've already established your ladder length, and then you know how many dollars, and you might have more than one bond per year, but it's generally good to look at it in dollars maturing per year. You might have 2 different bonds per year or 3 different bonds per year, depending on how big the account is.
Spread those out throughout the year. Yeah, it just depends.
How you want your cash flow to come in is kind of key here. But then say you have $1 million 10-year bond ladder, you could have $100,000 per year. And you could have that for 2 $50,000 bonds maturing at 6 months apart during the year. You can really work it out however you want, but that is a good way to do that. Now, Josh, I had a question for you as my favorite financial advisor. Here's, say Austin Wilson wants to create a bond ladder. I've got $1 million today to start a bond ladder. Should I dollar cost average buying my bonds or buy them all at once? Or pick and choose, try and time things.
It's a little different in that when you think of the stock market, if I wanted to buy Microsoft or Apple, just think of any large company, there's a lot of stock out there. So the only thing that fluctuates is the price, which is just moving based off of news, but the availability is there. Bonds, there's a limited quantity of bonds. So like you mentioned, if I'm Josh Robb's business and I only put out a handful of bonds for what my needs. So it's not like there's millions and millions of shares out there like you would think of a large corporation of stocks. Bonds are a little limited. So it is a little harder when you're building these ladders out, depending on the size that you're working with, to find bonds that fit your needs. You may say I have a 10-year ladder, $1 million. I'm building this out. And as you look through the different years, man, there's not a lot of choices for this one right here in particular that I like. So you may have to or be forced to kind of spread that out. The other thing is, if you're asking me right now, we just had a very rapid increase of interest rate hikes. The Fed is potentially looking at maybe being close to that peak. They may be done or a little bit more. So you're not going to see much upward, because that's what you could miss out on, is if I buy a 10-year bond and then interest rates go up, I could have bought an 8-year bond 2 years from now, maybe at a higher interest rate. So you're kind of playing that. But now's not a horrible time to be buying bonds if you're looking for yield.
Right.
You're probably collecting a little bit higher interest rate than you had a couple of years ago. Overall, it really depends on your goals, what you're trying to do. But there's a lot more limited quantity when you're looking for specific bonds than there is stocks. So it's just a different way of shopping for those.
Absolutely. So that's halfway through our list. Josh, I think we can take a break.
Yes, I have a dad joke for you.
Oh, you said it's a good one.
It is about bonds.
Oh, man.
What is the difference between men and bonds? Bonds mature.
Bonds mature. I thought you were going to say something about fixed.
No. Bonds eventually mature.
That's funny. All right, we got 4 more. Let's get through them. Number 5, after you have determined how long your ladder needs to be, how many bonds you want, based on each maturity, all of that, then you get to go choose your specific bonds. And I actually kind of enjoy this.
It is fun.
Going shopping.
Yep.
I call it. You bring a cart.
Yep.
You go, you just shop the sales, you try and find good deals. You do it on whatever platform you trade on. There is likely the ability to go find bonds. You can also work with your advisor to do this for you, and that's what I would recommend most people do who don't live in this world.
Yep.
But you need to research and select individual bonds that meet your criteria based on maturity, based on type of bond, based on yield, all of these different things here. I would say that it's very good to keep an eye on the credit rating of the bond you're buying.
Yep.
Now, lower credit rating, of course, is going to have higher yield, and that sounds great until companies go bankrupt.
Yep.
That does happen with lower credit rated bonds.
Yep.
So keep that in mind as you go. So really just look at an overall, say, hey, this is kind of the risk tolerance I have for this, and this is the type of bond and the credit quality I'm looking for this ladder.
Yep.
And kind of stick with what works for that throughout the maturity duration there.
And I'll tell you with that too, especially if you're building on a ladder like this, let's say you're buying municipal bonds. Pay attention to what or where you're buying. So if I buy, let's say in my build out, my 2-year, I find a great bond in Ohio. Great. Then if I'm looking in my 6-year section as I'm building this out, here's another Ohio bond. Now I have $200,000 of that $1 million portfolio in Ohio municipal bonds.
Yes.
Be careful where you go, diversify,
yeah.
because a lot of places will issue bonds on a continual basis, so that you may end up with owning the same exposure to some potential default in multiple areas.
It would be the same thing for corporate bonds.
Corporate bonds is the exact same
corporate
way.
bonds we don't want to buy. You might get great yields, but there's certain parts in the cycle, but we don't want to buy all energy bonds.
Yes.
Some energy bonds are good, but let's have some technology bonds. Let's have some consumer bonds and some banking bonds so we can spread out our risk.
Yeah.
Which is really the key.
And same true, you mentioned this. When you're looking for it, don't just say, that's giving me my most interest. Example, municipal. You may find there's some like Detroit bonds that are offering a little bit more. And you say, well, you know what? They kind of bankrupt themselves a little bit ago. Maybe I don't want to hang out there for too long. So just be careful. There's a reason why, if you're looking apples to apples, why one is higher than the other. And there's usually because the more risk, they offer more interest to entice you.
I would also say that you often, depending on where you're buying, have the ability to filter on insured bonds. So if a bond has insurance, that's essentially saying that the issuer has paid a third party to take on some risk in case of default. And you're going to get a lower coupon for sure. But you're also going to take on less risk. And sometimes that's worth paying up for. It just depends.
Those are getting harder and harder to find too.
Those are getting harder.
Since 0809, they've really had a harder time with that.
So after you've chosen your specific bonds, you have a basket, you packed up the cart, and you're ready to go check out, you have to go place your orders. So this is number 6. Place your orders. You choose all those bonds. You either do that through your brokerage, your financial advisor, your platform, whatever you're doing on yourself. That's okay. Just, make sure you're getting good prices and not paying crazy fees, because in today's world, you should have very limited, if any, fees when you're buying these sort of things. So check that. Make sure it seems reasonable before you check out, and pay for your bonds and stuff like that.
That's right.
So that's number 6, place the orders. Number 7, reinvestment plan.
Oh, yeah.
So a bond ladder, as I mentioned earlier, as that one in year 1 matures, or however many there are, you need to ideally go buy one at the end of the ladder, the next year or the next 6-month period or whatever.
Or fill in holes if you weren't able to find one.
Yep, exactly. Yep. So that's a reinvestment plan. You're going to receive that principal amount when the bond matures, and you've probably built up a little bit of cash in that account as well. So you can determine what you want to do with the cash that you've received in interest, but your principal amount should ideally then be placed in a hole in the ladder or the end of the ladder at that time. And this makes sure that at any given point in time, you have a full ladder. You're smoothing out your returns. You're smoothing out your risk at all different times for your fixed income sleeve that we're talking about right here with your ladder here. So that's the reinvestment plan. And the 8th and final point and step is to just continually monitor and adjust things. So, interest rates are going to move. The bond market's going to have wonky stuff happen. I mean, look at the last couple years. It's been rates were nothing, rates are a lot, bonds lost value, bonds gained value. It's just insane how things move in the short term. That's why having that diversified long-term ladder is going to be key, because it's going to take away some of that volatility over time. And then just make sure that you're overlaying all of that with your financial goals. Have things changed? Do you need more money sooner or less money sooner? You can adjust the length of that ladder however you want to. With most bonds, they are liquid enough to buy and sell them. If you need to adjust things, you can. You're not locked in most instances. So that's a handy thing there. So yeah, that's kind of the 8 steps of building a bond ladder.
Yes. And so I like that. I think, again, CDs are the same way. For people who are looking for a more stable, interest-producing concept, a ladder is nice because overall you get a higher yield for that time frame. Because you talked about this, that 10-year bond, in theory, should pay more than the short 1-year bond. In
most
theory.
instances, yes.
And the idea then is over time, you end up owning 10-year bonds because you're always buying one far out on the ladder. So as they keep maturing, all those short-term bonds become long-term bonds, and then you end up with a higher yield overall. It's a great strategy if you need income. Now, historically speaking, bonds struggle with keeping up with inflation over the long term. And so, like you said, if you buy a $100,000 bond when it matures in 10 years or however your length, you get your principal back, you get the $100,000. Well, inflation over that same time frame means everything's more expensive. So while you collected interest, if you don't have that interest along with the bond to reinvest, you're going to put $100,000, which is less purchasing power. So your bond portfolio over time actually is reduced in purchasing power if you're not reinvesting some of that interest along with it. Just something to keep in mind. Still a great way because you do see historically less volatility than you do in the stock market.
True. Yeah, last year was kind of an anomaly.
Yep. But overall, that's what it's designed for, people who need that income.
So as a reminder, bond laddering is a long-term strategy. It's not something that you could just look at for 3 months and have it all figured out.
Yep.
And because it takes time to smooth out your returns. It takes time to smooth out your income requirements. And that's kind of the benefit and the beauty of it all. I think it's also key to look back at years like 2022 and say, we need to know that there are a lot of risks in bond holding in general. So while you didn't sell, you haven't necessarily lost yet. Your bonds on a face value in terms of what you can get for them in the market through last year are probably quite a bit depressed in value. And that's because interest rates went up. Now, those will work themselves out over time, and you will get par value back at the end if you hold them to maturity, which is what most people recommend doing with a bond ladder strategy as we have right now.
Yep.
But there are a lot of factors moving bond prices, yields over time. So again, always smart to talk to your financial advisor because they hopefully know what they're talking about in this area here, which brings my question to you, Josh.
Yes.
Should you invest in bond ladders?
Well, the answer is depends.
Oh,
my favorite answer in the world.
I'm shocked.
We've said it a couple times. You really need to talk with your advisor and make sure that owning fixed income, owning bonds fits within your plan and your goals. But if you are, this is one way of diversifying your bond investments and building out a plan to collect a higher interest yield over time. So, do you need a bond ladder? I don't know. It depends what your goals are. Like I said, I've seen it used in many different ways, providing income in retirement, providing some stability. I mentioned the college tuition, timing the maturity dates to when you had tuition and just collecting some interest along the way. All different reasons why you could use one. It really just depends on your plans.
Absolutely. Well, that is bond ladders in a nutshell. Again, that was like the 50,000 foot view of what a bond ladder is. But hopefully that helps because bonds are a hot topic right now.
Yep.
Interest rates are higher than they've been in some time, and people are all of a sudden interested in fixed income again.
Yep.
So that was hopefully helpful. Thank you for listening. Again, if you had someone asking about bonds, asking about a bond ladder, share this episode with them. Hopefully they'll enjoy it and learn some as well. And if you have any ideas, here's a reminder. You can always email them to us. hello@theinvesteddads.com. Any questions, any comments, we'd be happy to talk to you about that. But until next week, have a great week.
All right. Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.